You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Persimmon, Greggs, Taylor Wimpey, ABF, Whitbread, and our US company of the week is Airbnb. Sam, shall I kick us off with Persimmon?
Absolutely. First house builder of the week.
Absolutely, yeah, that's right. And the second largest in the UK, York-based house builder, and one that I owned a number of years ago. They had their full year trading statement out. In fact, I was going to say last week, but we're 2 weeks ago now. Apologies for the delay. I was away on holiday. Persimmon's full year average net private sales were in line to the prior year at 0.7, with performance held back by a slowing market ahead of the UK budget in November. Completions were ahead of market expectations, up 12% to 11,905 new homes, and average selling prices were up 4% to 278,000. The order book grew by 2% to 1.2 billion, and the net cash position roughly halved to around £100 million, driven by increased land spending and continued shareholder returns. Full-year underlying pre-tax profit is expected to land at the top end of market expectations, between £415 and £440 million, pointing to growth of around 11%. For 2026, underlying pre-tax profits are forecast to be in line with the £461 to £487 million range. Build cost inflation is expected to remain at 2025 levels, and the shares were up around 2% in early trading. In terms of valuation, Persimmon has a market cap of £4.5 billion and trades at 1.22 forward price to book, with a 10-year average of 1.87. And it has a prospective dividend yield of 4.7% compared with a 10-year average of 7.5%. I thought these results were okay. Average selling prices were above inflation, but order growth slightly anemic. Completions were decent though, and we'll compare those later with Taylor Wimpey, which is the third largest house builder in the UK. I mean, they point to a difficult macro environment with the looming budget back in November, and I think that was a real thing. I would give them the benefit of the doubt there. I think also, we've had a lot of promises when it's come to deregulation in terms of planning, which we just haven't seen. Affordability is an ongoing issue. Inflation is still present. And I think that without any sort of stimulus, you're unlikely to see any huge growth or huge improvement in any of the big house builders. I think when the new government, Labour, came in, whatever it was, 18 months ago, there were certainly a lot of promises and there was a lot of optimism. I don't think we've really seen that in terms of practical policy or relaxation in planning. And therefore, it's largely sort of stagnant and has been, well, for the last few years since we've been covering the house builders on the show. I still have Barratt Redrow shares. I am optimistic longer term, but I have been saying that for a few years, and it's largely been this kind of situation. So I guess unless something fundamentally changes, we're probably going to see more of the same. I think when you look at the valuations, they're certainly cheap and they do reflect that sort of overall sentiment. So yeah, okay results. We'll come on to compare them with Taylor Wimpey later, but I don't think at the moment there's a huge amount to get excited about in the UK house building sector in the immediate near term, albeit there may be that long-term value opportunity. Sam, what are your thoughts?
I thought these results were pretty decent, but nothing to write home about. Nothing like the kind of results that would be required for the target of 1 million new homes to be hit. I agree longer term. I still like the sector. I appreciate what you're saying. We've been saying that since we started the podcast. But at some point, something has to give. And in the meantime, I think the valuation is pretty reasonable. The company's in pretty good shape. The balance sheet's strong. You're getting a good dividend. So although it's not ideal, I I think whilst you're waiting for unfortunately, it's going to be some kind of probably regulatory change, possibly to actually unlock some of that value. But I do think eventually it will happen.
So, Sam, how are Greggs doing?
So, Greggs are doing okay. So, we have covered them multiple times before on the show. Really, since lockdown, they've done very, very well since then. And Greggs have come out with their full year trading update, and they expect to report 2025 sales of 2.2 billion, which reflects 2.4% like-for-like growth in company managed shops. Fourth quarter growth was 2.9%, which accelerated from 1.5% in the previous quarter, helped by market share gains. Across the year, there were 121 net new shop openings, bringing the total to 2,739 stores. Greggs is targeting around 120 net new openings in 2026, and that's below the 134 that was expected. Year-end net cash came in at 78 million, lower at 47 million, and the group expects significantly lower levels of capital expenditure in 2026. Management expectations for full-year pre-tax profit remain unchanged. The consensus forecast stands at 173 million, and that's down from 190 million a year ago. In 2026, underlying profits are expected to remain at 2025 levels compared to market expectations for growth of around 4%. And the shares were down 3% following the announcement of the results. Obviously, costs have been an issue for Greggs, especially since the budget for growth we had last year, with the minimum wage going up, NI going up, and then sort of other general inflationary issues. So price hikes, they've been used to help offset that, and they've actually been the main driver of growth rather than volume. We have discussed it before, the number of shops, they are targeting 3,000. They are now at 2,739, so they're pretty close to that. As well as a store expansion program, they've been setting up 2 new distribution centres, which is where all the capital's been going. In terms of valuation, the business trades at a forward P of 13.6, and that compares to a 10-year average of 22.3. The prospective yield is 3.9%, and that compares to an average of 2.7. We have discussed it before, but I think Greggs is now a different type of business to what it was a few years ago. So when you're looking at that 10-year average, I think you have to take it with a pinch of salt. Although I think the forward P of 13.46 is reasonable, I just think you're probably not going to see the same levels of growth. You're going to get a bit of a bump when they go to 3,000 stores. I think they will hit that because they're so close now. But what next? And it's quite difficult to answer. They've already started opening the stores later. They've already started putting stores sort of on industrial estates and maybe places where you wouldn't have previously you wouldn't have expected them. And I think they've really done a good job at sort of pulling all these levers, but they're now at the point where I'd be looking at them and thinking, well, what next? And it does feel like a lot of people have kind of dived into the Greggs stock, especially since it has dropped in the last couple of years. So it's been as high, it's been over £30 a share. It's now at £16.58. And it had a low of £14 earlier, last year now, but within the last 12 months. I think it's a reasonable valuation for a decent business at 14 times earnings.
Yeah.
But I think without that expectation of significant growth going forward, I think the opportunity cost, you could do better than Greggs now. I think there's better businesses out there. What about you, John?
Yeah, no, I would largely agree with you there. I'm not sure where the growth continues beyond this, and it's not the sort of stock that you'd say, well, they could expand into Europe or they could expand to the US. It's much more of a UK story, and it feels like they've done as well as they could. The other thing is that they do have the headwinds in terms of higher employment costs. There's still significant inflation around, and I think when you're at the lower end of the market, it's more difficult to deal with those things and to offset. So I wouldn't be especially bullish on Greggs. I do think it's a great company, and the growth that it's nearly managing to get to 3,000 stores from when we started 5 years ago is incredible. And the expansion that they've managed to execute, particularly in the south of England, when it was a Newcastle-based company, I think they've done a great job. But I think there are better businesses at this stage to invest in, so it wouldn't be one for me.
So in that case, should we move back to house building?
Yes, absolutely. So as I said earlier, on to our third biggest, or the third UK house builder, which is Taylor Wimpey. They had a trading statement out 2 weeks ago with full year revenue rising by around 12% to £3.8 billion. And that was driven by total completion growth of 6% to 11,229 new homes, and average selling prices rising 5% to £335,000. The order book declined by around 100 million to £1.9 billion, reflecting a backlog of 6,832 new homes, and the net cash position fell by around 200 to £300 million. 2025's operating profit is now expected to rise from around 416 million to 420 million pounds, slightly below prior guidance of around 424 million pounds. In 2026, the group's operating profit margin is anticipated to fall from 2025's level due to weaker pricing and low single-digit build cost inflation, and the shares were down nearly 4.5% in early trading. In terms of valuation, Taylor Wimpey has a market cap of £3.76 billion and trades at 0.87 times forward price to book, with a 10-year average of 1.38, and it has a prospective dividend yield of 8.7%. I thought these results were disappointing, particularly seeing the order book declining. I know they've got a backlog and also net cash falling. The revenue growth was decent though, and the completion growth was encouraging at 6%, although that's about half of what Persimmon was. Average selling prices slightly above what Persimmon managed, but not significantly. Also, it's disappointing to see the operating profit margin being squeezed, the weaker pricing, and the lower single-digit build cost inflation pressing on that. My feeling overall, though, is that similar to Persimmon in terms of the overall house building sector, I think at 0.87 times forward price to book, compared with its 10-year average of 1.38, and still a decent dividend, I don't think that with these numbers, albeit slightly disappointing, they really justify a valuation of quite that cheap. And certainly when you compare it with Persimmon at 1.22 forward price to book, it looks to me like quite good value. I do like Taylor Wimpey. I have owned it in the past. So I think there is a value proposition there. When that is realised, well, that is the big question. But you would hope at some point in the UK, with that structural imbalance of demand and supply, and that we have a chronic housing shortage, that is addressed, and Taylor Wimpey, you would expect to be a major beneficiary of that. And in the meantime, as long as they're still generating decent profits, that you're going to have a juicy dividend as a reward. Historically, they've been a great operator, certainly after they reformed post-2008. I do like it, and I think there's more of a value proposition there than there is with Persimmon. Sam, what are your thoughts?
Pretty similar. I think of the two, I think the Taylor Wimpey results are worse. I'm assuming that's just because of where they sit in the market. Persimmon's bigger in the north. I think they're both in sort of the affordable end of the market, but Persimmon's maybe a bit more at that sort of first-time buyer area of the market, and I think being in the north does help. But I don't think it's enough to justify that price difference. I think historically I've preferred Taylor Wimpey as an operator. I think Persimmon's had more issues with build quality, and Taylor Wimpey, in terms of sort of where they increased the land bank in COVID, I think that was really, really smart. So I think in the time we've covered it, I've probably preferred the way Taylor Wimpey's been run. So of the two, I think if you could get Taylor Wimpey at a 8.7% yield compared to 4.7% for Persimmon, I think I would definitely prefer Taylor Wimpey.
Yeah, we've covered those two of the three biggest house builders. If we looked at Barratt Redrow, so that was the merger between Barratt and Redrow, which happened in the last couple of years, their valuation at forward price to book is just 0.65. So that's even cheaper than Taylor Wimpey. I think it's interesting comparing the three, because one of the things that you see more with Barratt and Redrow is predominantly southeast and also much bigger, more expensive properties. So you've got an even deeper discount there. So it depends, what you're looking at in the market. Certainly the figures I think we've seen from Persimmon are the best. And then you've got sort of Taylor Wimpey and Barratt Redrow lagging behind. but that is, reflected in the valuation. I think it would be interesting in terms of what happens with the lifetime ISA sort of reforms. I know they're currently under review, but if there were anything like, for example, increasing the amount or the value of the property that you could use the lifetime ISA for a deposit, you wonder whether that would shift any serious, demand for and affordability for some of these properties, whether that's, well, in fact, it could include Persimmon, but probably more relevant to Taylor Wimpey and to Redrow.
Yeah, I would agree with that. I think Persimmon's probably benefited the most from that lifetime ISA cap staying where it is. Also, it's not a huge difference, but like for stamp duty, first time buyers.
Yeah.
Yeah, I think that doesn't kick in till 300,000. And what's Persimmon's average sales price? It's 301,000. And they are at that more affordable end. So again, that kind of almost stagnation you've had in those reliefs for first time buyers probably has helped Persimmon comparatively compared to rivals.
Yeah. No, I'd agree with that.
I just don't see much of a difference other than sort of where they are regionally, because they're pretty similar.
Yes.
They're pretty homogenous. I do view the house builders as quite homogenous once you get to the top 3 or 4.
Yeah, no, I would agree with you. I mean, I think Barratt Redrow, perhaps slightly different. I think the regional aspect to it, and also probably when you look at the Redrow part of the Barratt Redrow, where it is the larger houses, which are higher selling prices, I think that's where potentially the things like the lifetime ISA, etc., and I guess anything that induces first-time buyers, if it is capped, that it's more beneficial towards those ones that are primarily first-time buyers. And I think Persimmon's the great example where that is north. Well, it's a York-based house builder, but much more northern exposure and lower house prices. So as you say, less impacted or restricted by some of those policies.
Should we move on to ABF, a favourite of the show? I think
Yes,
it's fair to say.
Absolutely. How are ABF doing?
Not well, unfortunately, which doesn't bode well for our fantasy portfolio, which they remain a part of. So, Associated British Foods, we've covered them multiple times, so I don't really think they need an introduction, but I think it is useful to go over anyway, because some of the brands have got fantastic. So the jewel in the crown of ABF is Primark, but they have loads of other businesses, a lot of grocery and retail businesses. So they've got like Jordan's, the cereal brands, Ryvita, Twinings Tea, Ovaltine, Kingsmill Bread, Patak's curry sauces, Allison's Flour. They've got the White Spoon Sugar. They've also got, which brings us on to the commodity side of the business, which is the sugar. And then they do a lot of other sort of food businesses as well. So like ingredients and like yeast ingredients and stuff like that. They do stuff like pet food and stuff as well. So more of really kind of a quite vertically integrated food conglomerate really. And then they just own Primark too. So they have come out with a trading update, and total sales fell by 1% over the 16 weeks to 3rd of Jan, ignoring exchange rate impacts. This comes as 1% sales growth in both the retail, which is Primark basically, and grocery businesses were more than offset by low single-digit declines in all the other food businesses. At Primark, like-for-like sales fell by 2.7% as sales growth and market share gains in the UK were more than offset by weakness in continental Europe. Full-year guidance has been downgraded. The group had previously expected underlying operating profit to grow from last year's 1.7 billion, but now expects to fall below that level, and the shares fell 11.4% following this update. A big part of the growth has been overseas, and new stores are meant to contribute around 4 to 5% in annual sales growth for the foreseeable future. If we break the results down geographically, I think it paints a bit better of a picture. So in terms of where the sales come from I'm just going to focus on Primark, but in terms of where the sales come from for Primark, 45% is UK and Ireland, 49% is Europe, excluding UK and Ireland, and only 6% is the US. If you look at that like-for-like growth, UK and Ireland is up 1.1%, so that's okay. Europe, excluding UK and Ireland, is down 5.7%, and they've not given the figure for the US. However, if you look at total sales growth, up 2% for UK and Ireland, that's fine. Down 1% for Europe, excluding UK and Ireland, that's not great. But I still think the real opportunity is the US. And the sales growth for the US was 12%. I'd be pretty happy with that figure. The only thing is it's 12%, but it's only 6% of Primark's revenue, so it's a very small base. But in terms of driving that future growth, we talked about it before, but that's where we'd hope it would come from. Of that, the US business, half of the sales are actually produced in the US in terms of the products. So the exposure to tariffs is limited. And it has been talked about before, but they are considering spinning off Primark. They've not made a decision on that yet, so there's not really any update. But that is something they're considering, separating the food business and the Primark business. In terms of valuation, the business trades at a forward P of 11.5, has a 10-year forward average of 16.5, prospective yield of 3.1% compared to a 10-year average of 2.3%. I think for a business of this quality, I think 11.5 PE is very reasonable, especially when you do have that US opportunity for Primark. I think what's happening really, which I think is why they're considering spinning it out, I suspect the value of Primark is being dragged down by the food business, but I quite like having them together. I think you've got a strong portfolio of quality businesses. They're not all going to perform at the same time, but I think you've got a very, very good business in ABF, and I do like it. What do you think, John?
Yeah, obviously, I think it's a bit disappointing with the results, but as you say, the growth case for it with that, albeit small US market. Well, it's a big market. They've got a small share of it at the moment, but the case for growth there with the current valuation, I do think is really attractive. And it's very different from, for example, Greggs, where it's kind of UK based and saturated. I know what you mean about the foods business, and particularly with the commodity exposure, there is a large degree of cyclicality with it. I would probably like to see the business remain together, and I haven't yet pulled the trigger in my own portfolio, but just on the update now and seeing the current valuation, it's very, very tempting. Very tempting. Yeah, I have to have a think over the next week.
Oh, very interesting. So if you did buy it,
yeah,
and they did say in a year's time spin out Primark, would you be inclined to keep both businesses?
I probably would. I mean, it always depends, but I probably would, yeah.
Yeah, I would as well. Unless one of the valuations was just really silly for one business and not the other. I don't see why you wouldn't.
Yeah.
Right, shall we move on to Whitbread?
Yes, absolutely. So we've covered it a number of times on the show. It's a business that has owned a lot of businesses in its time. Most recently, it's been a combination of essentially Premier Inn, the Harvester, a few of those kind of pub-type grills, and it owned Costa until... I mean, I've always said they sold it a couple of years ago, but let's see when they actually let it go.
I think you might be about to age yourself, John.
Yeah, I know. So Costa, they finally sold, they sold Costa back in 2019. So to me, that does feel like yesterday when Whitbread sold Costa, and they sold it for nearly £4 billion to Coca-Cola. So essentially, it's really been Premier Inn story for the last 6-7 years.
Probably worth adding, they did very well on the sale based on how Coca-Cola's done since.
Absolutely. So, I mean, Coca-Cola are talking about, the rumour is that they're going to sell it, and probably for about half that price. So maybe around sort of the £2 billion mark. So it does look like Whitbread actually, when they sold it, kind of sold it at the top end of the market. You know, when that coffee market was really buoyant, before the commodity prices with coffee beans going up significantly. I'm also like when Costa was kind of at its zenith and it was the dominant one on the high street. I think if you do go back to 2019, yes, you did have some independents on the high street. I think they've become a lot more popular and people moving away from that really commercial sort of coffee space. And also, before you had those kind of cheaper entrants to the market, where Greggs has now become much more popular, kind of at the bottom end for coffee, and also having a decent coffee available from McDonald's, you know, from bean to cup. I think that has changed things. And then you felt that Costa has kind of lost its way in the middle of the market. Anyway, it's not a business that Whitbread owns anymore. So we will move on to Premier Inn. So overall, Whitbread's third quarter sales rose 2% to £781 million. UK accommodation sales grew by 2.3%, driven by strong pricing, which more than offset a small dip in occupancy. Restructuring of the group's branded restaurants contributed to a fall in food and beverage sales, and sales at Premier in Germany were up 17%. Cost saving guidance for the year is improved by about £10 million to £75 to £80 million, and the cost hit from changes to the business rates regime next year is now expected to be £10 million lower than first thought. A £250 million share buyback programme is now close to completion, and the shares were up nearly 4.5% in early trading. In terms of valuation, Whitbread has a market cap of £4.62 billion and trades at 1.5 times forward price to sales, compared with an average of 2.5 times over the last 10 years. And it has a prospective dividend yield of 3.9%. I thought these results were very good. I think the key result is really the sales growth in Germany being up 17%. And for anyone who doesn't know, well, Premier Inn, it's probably the biggest single operator up there with Travelodge in the UK and largely saturated in the UK market. So what the company have been doing in terms of the growth strategy is investing heavily in the German market, and they've been expanding there, with that being a much more fragmented market, which something that we weren't aware of, and then we followed the strategy. It seems to be working very well, and I think that is the investment case primarily for Whitbread now, is the Premier Inn expansion in Germany, which so far is so good. There are some headwinds in terms of business rates, but they're actually a bit better than we thought. They have all the same problems that a lot of the other lower cost operators in the UK have, particularly in terms of national insurance hikes, minimum wage hikes. They do hit the business, but I think that encouraging figure from Germany is a really positive one for the overall investment case. And I don't think at 1.5 times forward price to book, it's at all unreasonable. I know we were skeptical of Whitbread, particularly when we started the podcast, and that was immediately in the aftermath of COVID, and numbers were completely shot, but they have recovered incredibly well, and now the business is continuing to expand in Germany. I like it. I don't know whether I'm at the point of buying shares in it, but I do like it. I think the Germany strategy is good. I think the thing that probably puts me off or makes me wary of the sector is how much capital expenditure is required, particularly with all those hotels that they own. You know, you compare it with a model like IHG, where it's more of a franchise and there's much less in the way of capital expenditure. That capital-light business, that probably is more attractive. However, I think Premier Inn and Whitbread are doing a good job in the business that they're in. Sam, what are your thoughts?
Very similar. I think it was a really good update. I think, like you say, the focus is on the German story because that's where the growth's coming from. Continuing to deliver on that. Really, really good operator. It's a business I've definitely come to admire a lot more. But like you say, it's the industry that's the problem. It's a bit like, I actually think I probably prefer it to Wetherspoons, but it's a bit similar to Wetherspoons, where there is no level at which Wetherspoons could perform where I'd be interested in buying the shares. And that's no reflection on how well management is doing. It's just the industry. But it's doing really, really well. I do prefer the IHG model, but I think with the model they've got, I don't see what else they could be doing. And I do think that German growth opportunity, it is there. I did actually try a couple of their Premier Inn Germany's when I was in Berlin a couple of months ago.
Oh, yeah?
And in terms of the experience, exactly the same as the UK. So there's not much to report on, but I suppose it's you know exactly what you're getting. And I'd had it before, actually, where I'd been to Germany a couple of years ago. And because we tend to be, it was more of a city breaks that we do. We tend to be out a lot during the day. We literally just want somewhere nice where we can crash, but we don't want to be spending like £300 on a room that we're not going to be in. And Premier Inn, it ticks that box very well. Whereas previously, in some of the hotels we were in Germany, they were okay, but we were in that, with it being more fragmented, you could see that last time. And being able to go and stay in a Premier Inn, it just took that out of the equation. So I can see the use, sort of the appeal of it. If I was to go back to Germany, I would probably be quite happy staying in a Premier Inn again. Arguably, there's maybe other countries in Central Europe where they could do something similar. I don't know what the market's like in Austria, for example, but you imagine it would be pretty similar. So you do wonder if they do get to that point where they sort of are a bit more dominant in Germany. There's probably other countries with a similar kind of model. So yeah, I think it's a really, really good business, actually. It's just the industry that puts me off.
On to, well, something that's in a similar industry, but that is very capital light. Airbnb.
Yes, and a business that I own. So Airbnb, sure it needs no introduction as it is the verb, have come out with their Q3 results. These are actually a couple of months old, but there's not really many interesting US companies reporting this week. And as a shareholder, I thought it'd be quite useful for me to go and look at them at some point anyway. So Q3 results, all these figures are in dollars. Revenue up 10% year over year to 4.1 billion. Net income up. Well, net income was at 1.4 billion, so that gives a 34% net income margin. Adjusted EBITDA was at 2.1 billion, giving a 50% adjusted EBITDA margin. I'd be inclined to go with net income margin, but 34% net income is still very good. Free cash flow, 1.3 billion, 33% free cash flow margin. Gross booking value was up 14% year over year to 22.9 billion, but 12% if you exclude currency movements. Nights and seats booked was up 9% year over year to 133.6 million. They've given an update on some of the new features that have come out. So that includes reserve now, pay later. They've said, we know guests want more flexible ways to pay. So we recently introduced a feature in the US that gives guests the option to reserve an eligible stay and pay $0 up front. This helped drive the acceleration of nights and seats booked in Q3, and we continue rolling it out more broadly in the coming months. I think I've used that, or if I've not, I've used something very similar where you pay a very small amount on reservation. So I was reading something online where apparently one drawback of this is the cancellation rate's higher because people are able to book stuff that they maybe can't afford and then cancel it later. But like, for example, I did a holiday with my siblings in the summer, and getting the money off people, whilst it's doable, it can sometimes take a while. So being able to reserve it now and then get the money in a few months, it was actually a really useful feature. So I did use it then. Updated cancellation policies. They're helping hosts earn more and guests make changes by more easily updating the cancellation policies. Hosts can now choose a new policy that allows guests to cancel for free up to 14 days before check-in. And all stays under 28 nights, guests can cancel for a full refund up to 24 hours after their reservation is confirmed if they book more than 7 days before check-in. Initial tests show that these changes are reducing customer service cases and increasing annualized bookings. Again, I expect this is probably contributing to this slight increase in the cancellation rates. But overall, I think as well, if the guests can actually choose it for the most part, the host can choose it for the most part, they'll know what works for them. So I think that's a good option to have. Improved maps. So when you look at Airbnbs, it'll show nearby landmarks, public transport, restaurants, and later this year, guests will also be able to see different map views, including satellite, street, and transit. And flexible carousels. When guests search for a place to stay, they'll see homes just outside their search criteria. They've said the average growth rate of nights booked on an origin basis in their expansion markets continues to be twice that of our core markets in the past 12 months. Our strategy includes attracting new users to the platform, and we're seeing some big wins in some of our key markets. First-time bookers increased over 20% in Japan and nearly 50% in India in a year-over-year basis. And in May, we took the first step expanding Airbnb beyond stays with the launch of Airbnb services and reimagined Airbnb experiences. Since launch, feedback has been overwhelmingly positive, with services and experiences receiving an average rating of 4.93 out of 5 stars. These new offerings also bring new people to the platform. In Q3, almost half of experiences booked were not attached to an Airbnb accommodation booking. While scaling high-quality supply will take time, we've received over 110,000 applications from potential services and experience hosts. I haven't used that yet, but I think that is quite interesting. For the outlook, they've said in Q4, we expect to generate revenue growth of 7 to 10%, including a small foreign exchange tailwind. Q4 gross booking value and nights and seats booked, expect that to grow low double digits. And full year adjusted EBITDA, they expect the margin to be approximately 35%. On the geographic performance, they've said Airbnb is in over 220 countries and regions, and yet the majority of our bookings are in 5 countries, highlighting a significant opportunity. So if we look at the results by region, in North America, they saw mid-single digit growth of nights and seats booked during Q3 compared to 2024, representing sequential acceleration driven by strong domestic travel and trips with longer lead times. In Europe, Middle East, and Africa, they saw mid-single digit growth in nights and seats booked. And during Q3 2025, they faced a slightly unfavourable year-over-year comparison in the region due to the Paris Olympic and Paralympic Games last year. In Latin America, they saw low 20s growth in nights and seats booked. And Brazil continues to drive meaningful growth across the region, with Origin nights booked increasing over 20% as the number of first-time bookers increased 17% in Q3. Asia Pacific saw mid-teens growth in nights and seats booked compared to Q3. And in terms of the valuation, business trades at a PE ratio of 31. I'll just check the price to free cash flow, and just 18 times free cash flow. I think for a business of this quality, Airbnb is the verb. I think there's still a lot of potential for expansion in the other countries. I think one thing that will really help Airbnb in terms of expanding geographically is that although they might be most dominant in 5 countries, those 5 countries are sort of Western countries that are some of the richest in the world. So like you take US, which is obviously their biggest market. I think the thing is, when Americans are going to other countries, they're going to be looking on Airbnb. So it kind of fuels that growth because people have to be on there because that's where the people from the richer countries are looking for the properties. They've also got the experiences side. And I just think we're not really close to getting to the point where sort of it's fully saturated yet. It's just a fantastic business. I'm very happy holding it. I think the results aren't anything to write home about, but they are still solid, I think, for the valuation. And I think there's still a lot of runway ahead. Now, it might be that this is a sort of a steady grower at 10% a year for a while, but I think it's got a lot of runway ahead of it before that growth starts to dry up. What do you think, John, as someone who's less biased?
I do like the business, and I think it's a very high quality company. I would completely agree with you that it's not saturated, and the fact that it's a verb tells you an awful lot. I suppose the thing that I'd be slightly hesitant over is at 31 times, is it 31 times forward earnings, did you say?
Actual earnings.
At 31 times earnings, it is expensive. And I know it's not the same industry, but you look at, for example, a Rightmove now. I think if you look at the UK market going sort of back home, and I would look to Rightmove, and I think when you look at the valuation there, it's even more attractive than Airbnb. And I think probably less risk involved valuation-wise, possibly for an even higher quality business. And I'd probably put my money there over Airbnb. So I think there's some sort of opportunity cost, and particularly with it at 31 times earnings.
I think my counter to that would be, I can't remember Rightmove's net income off the top of my head, but the operating margin's about 70%. If we take another very high quality FTSE listed business, Baltic Classifieds, which is very similar, operating margin about 70%. If we take a similar kind of business in a different industry, Auto Trader, operating margin, I think it's 60%-ish. So it's a bit lower, but still. You go to Airbnb, the net income margin is 35%. So I think Airbnb's got much more opportunity for growth still, especially with the experiences side of the business. Whereas Rightmove, it is a UK story. It's pretty saturated. Great business though. Baltic, don't know how saturated it is. I think that's reflected in the valuation now. However, the Baltic market is going to be a lot smaller. But yeah, again, really, really great business. Airbnb, I think it's still got a lot more scope for revenue growth. But as well as that, I'd expect that margin to come up significantly over the next 5 or 10 years. And if we're sat here in 5-10 years' time and that operating or net income margin isn't at least 50%, I'd be very, very surprised. So if you factor in the revenue growth and the increase in the margins, I think all of a sudden it starts to look a lot cheaper. That would be my counter.
Fair point.
So of the 6 businesses then, Persimmon, Greggs, Taylor Wimpey, ABF, Whitbread and Airbnb, which do you like the most and which do you like the least?
Oh, good question. I think putting that I own a house builder aside, I think I'll go for ABF. I think that's a quality business and it's a very attractive valuation with good growth ahead of it. Last, I'd probably go for Greggs actually. I think it's not a bad business by any stretch, but I feel like its days of growth are probably over. So therefore, sort of almost by default, because I don't think there are actually any bad businesses this week, but I'd put Greggs as my last choice.
So I'll exclude Airbnb because I own it. ABF, I think, is probably the best business besides that one. I think the valuation is very attractive. Least favourite, I mean, Whitbread I wouldn't invest in because of the industry, but I just think the performance has been so good, and I do like the business. I don't feel like I can put it least favourite. I don't think that's fair. I know Whitbread doesn't care, but I think I'd probably have to go with Greg's as well. I just don't. I think we said it last time we covered it, but I don't really know where it would sit in a portfolio anymore because I don't think it's quite attractive enough to be an income stock. But I'm not sure where the growth's going to come from beyond the short term because I think they're a couple of years away from hitting those targets that when we started covering the show were medium-term targets, and now you look and you say, well, what's next? And I don't know. Maybe they'll think of something, but it's not obvious to me. So I don't think that's reflected in the valuation.
No, fair enough. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.